Hello everyone, this is Marty Becker, owner and founder of Atlas Financial Strategies in St. Louis, Missouri. I'm coming to you today in video format because I've been wanting to write a newsletter on this topic for a while, and it's just too lengthy to do in a written format. I was convinced that most people would fall asleep trying to read an article on this topic because of the amount of details that go into it. But this is a very, very important subject that deserves your understanding. So in this week's newsletter / video, I'm going to show you exactly how annuity companies protect your money and make a profit for themselves. So let's start with some of the basics about insurance / annuity companies and fixed indexed annuities. Now, FIAs are tied to or quote track an index, but they are not invested into that index. Now, what's an index? An index is a group of publicly traded companies lumped together and create a quote index. The most well-known is probably the S&P 500, which is a group of 500 companies that cover all the sectors of the American economy. Now, the performance of those companies as a whole depends on if the index is up at the end of the year or down at the end of the year. Now, everyone's probably heard of the S&P 500, but I believe the last time I looked, there are over 5,000 different indexes that exist. So depending on the annuity company you work with will depend on what indexes you have the option to track. Some more of the basics here. FIAs are issued by an insurance company, and I'll be using insurance company and annuity company interchangeably in this video. But FIAs give you exposure to a stock index for the opportunity to earn higher interest credits than you could with just a fixed interest annuity. The way you are issued those interest credits are via one of three crediting strategies, and that's via a cap rate, a participation rate, or a spread. Now, I've written pretty extensively on the subject, but just a quick example of how those work are a cap rate is exactly what it sounds like. It's a cap or a ceiling that you cannot surpass. So if you have a 5% cap rate and the index goes up 10%, you get a 5% interest credit. If it goes up 20%, you still get 5. A participation rate or a par rate means you participate in accordance with the percentage you have. If you have a 50% participation rate and the index goes up 10%, you get 50% or 5% interest credit. If it goes up 20, you get 50% of that or whatever the ending index value is. Now, a spread means you get anything above the spread rate. So if you have a spread of 5% and the index goes up 10%, you get credit 5. If it goes up 20, you get 15% interest credit, so on and so on. Now, what is one of the biggest misconceptions about annuities and annuity companies? It's really that the annuity company is going to keep the difference between your crediting strategy and the ending index value. Now, what does that mean? There are people who believe, or want you to believe, that if the index ends with a 20% increase and you have a 5% cap rate, that you get 5 and the annuity company keeps the other 15% for themselves. All those greedy corporate fat cats keeping all the money for themselves, so you should put your money in this mutual fund instead because nobody's getting rich off of these things. I mean, give me a break. That is absolutely 100% not true, and it's not even close to how this whole thing works. And you know how I can prove that right out of the gate? Because if that were the case, you would never get a participation rate of 100%, much less a higher participation rate. What I mean is that there are hundreds of examples of companies that will give you a 100% participation rate or greater. Meaning if you have a 120% par rate and the index goes up 10%, the annuity company will give you 12% interest credit. They couldn't do that and stay in business very long if that's how this whole thing really worked. They can do that because there are no deals in the insurance industry. Everything is based on math. They can offer you participation rates because of math, not because they're nice or they think you're a good person. It's just math. It's really that simple. And all of this math is based around call options. Now, what the heck are call options? The simplest way I have ever had someone explain it to me is with a real estate example. So let's say that you knock on my door and say, "Hi, I'd like to make you an offer. I will give you a check for $5,000 today in exchange that you sign a contract that gives me the option to come back and purchase your home anytime in the next 3 years for today's value of $100,000. Okay, so what's the catch on that? No catch. You just have to agree to sell it when I want it, but I also don't have to buy it if I don't want to. So if I do not come back within the next 3 years, then my option expires and you keep the $5,000. Now, why would you make me an offer like this? It sounds a little insane, okay? Well, maybe you have information that says Amazon is going to build a giant warehouse 2 miles away, and there is going to be a massive demand for housing in this area. So you are speculating that this house will be worth $150,000 in the next 3 years, but the Amazon deal is not done yet. There is still uncertainty, and you are not willing to risk the entire $100,000 to buy the house outright. So there are only 2 scenarios in how this plays out, and this is interesting. Number 1, Amazon builds the warehouse, the value of the home goes up to $150,000, and you get to buy it for $100,000, and then you turn around and sell it immediately, creating a healthy profit of $45,000 for yourself. Or number 2, maybe they decide to build a prison in that same spot instead. And now that same house drops in value to $75,000 and you let the option to buy expire. So you lost the $5,000 you gave the homeowner, but the alternative would have been that you bought the house outright and now it's worth $25,000 less than what you paid for it. This exact same thing is done in the stock market every single day, and you can make a ton of money if you're right, or you can lose a lot of money if you're wrong. Okay, but what does this have to do with how annuities protect your money? Here's how it works. Your premium, along with thousands of other people, is invested into long-term investment grade bonds and fixed income assets. And let's say that portfolio gives the annuity company a 5% return. Now, you may be saying, how can they get a return of 5%? Especially in safe products like that. Well, when you're investing billions of dollars, you can get a better rate than you or I could as individuals. It's really that simple. It's volume. And let's say the annuity company has a margin of 2%, 1% for their operating costs, and another 1% for profit. Now, again, you may also be saying to yourself, hold on, they're only making a 1% profit. Who would do that? Well, they would. I once heard an actuary say that the insurance company's goal is to make a profit between 0.5% to 2%. So a 1% profit on a company that has $100 billion is an astronomical amount of money. So that's it. That's their goal. 0.5% to 2% profit. So what happens after that is now they have 3% to offer their clients in the form of an options budget to help them get a better return in their annuities, rather than if they just gave them the 3% as a fixed interest rate. And where is all your original premium that you sent to them? It's still safe in their investment portfolio and long-term investment grade bonds. And by the way, this is why there are surrender charges, because the annuity company has the money in long-term products, and if you just randomly change your mind one day and want the money back, they will have to pay a penalty for selling those assets, and that's just going to get passed on to you, okay? Okay, everyone's still with me here, because this is the most important part that almost no one understands. And after we finish the slide, you'll be able to stop someone when they say something stupid like, well, annuities just capture growth so the insurance company can keep all the money. You can stop them and say, actually, that's only one of 3 crediting strategies. And the reason they do that is because of this slide right here. Okay, we ready? So like we saw in the last slide in this example, after the annuity company's operating budget and profit, that leaves them with an options budget of 3% to provide you with opportunity for growth. They take that 3% budget and buy a contract that gives them the right to buy a stock index for today's price in the future, with the hope, obviously, that the value of the index in the future will be greater than it is today. But the problem comes when the cost of the option is greater than the options budget they have available. So if they only have 3% and they're routinely buying options at 8%, they won't be in business very long. So in order to make this work, they have to enter into an agreement with a counterparty to buy the option from them at a higher price to even out the difference between the budget they have and the cost of the option. And in this scenario, this is how you would end up with a 5% cap rate. So if the annuity company bought the option at $100, they would turn around and sell it to a counterparty for $105. The annuity owner, you in this case, would keep everything between 0 and 5% of the interest gains. And the counterparty would keep everything above the 5% gain. How much of the money did the annuity company keep for themselves? Anyone? Nothing. The annuity company gets absolutely nothing out of this transaction. This is the service or the value they are providing their clients to obviously attract more people to put their money with them. So this is the product they are selling, if you want to think of it that way. Now, what is the worst case scenario in this process? The index value could actually drop, the option expires, and the 3% budget is lost. But remember, that money was already allocated for this process. And remember where your money is? It's in the annuity company's portfolio in long-term investment grade bonds. Your money is still safe. So worst case scenario, you get nothing that period as far as interest growth goes. And the saying for that is 0 is your hero, meaning you lost nothing and your money is still safe and protected in the annuity company's investment portfolio. And this is exactly how it works with participation rates as well. You take the options budget and divide it by the cost of the option, and that will give you the percentage of the participation rate. That's how you get a participation rate over 100%. When the cost of the option is lower than the annuity company's option budget. Again, it's all based on math. So when you see a more expensive option, like this example of the 8%, this is indicative of a volatile index like the S&P 500. When you see a higher participation rate, that is indicative of a more stable index, like a risk-controlled or a volatility-controlled index. So kind of the rule of thumb is the more volatile an index you're tracking, the lower the participation. The more stable the index, the higher the participation. So just a quick recap. What are some of the key points here? You can participate in market-like returns without the risk of having your money in the market. The annuity company does not invest your money in stocks. They are buying exposure to a stock index. The annuity company does not keep the profits above the cap rate or the participation rate for themselves. The annuity company's profitability does not depend on market performance. Fixed index annuities are made possible by very sophisticated investment strategies that you and I could not do on our own without taking massive risk. Again, there are no deals in the insurance/annuity industry. Everything is based on math, which, in my opinion, makes these not only the safest financial products, but also the fairest financial products that are offered anywhere in the financial world. So, everyone, that was it. I wanted to keep this short and succinct. Go back and watch as many times as you need to understand it. But I do want to thank everyone for watching this, and hopefully it gives you some insight on how these products actually work. If you're looking for further information on these safe money products, I highly encourage you to go to my website at atlasfinancialinc.com, where I have tons of educational information. You can also go to YouTube and search for Atlas Financial Strategies, where you will find more videos like this. And if you ever want to talk or just have some general questions that you feel like you're not getting a straight answer to, there are several ways to get a hold of me. Email will probably be the fastest at marty@atlasfinancialinc.com. Or you can call me directly at 636-926-6500. Or you can see my availability on the calendar page, which can actually be found directly at www.atlasannuity.com. atlasannuity.com. And you can actually block a time to have a short conversation. Again, thank you everyone for watching, and I wish you the very best on your educational journey.